How can average citizens like us, how can we benefit and profit from preventing our financial system from collapsing? This is the question we ask on the Crowd Effect podcast. I am your host, Paul Lovejoy, activist investment advisor at Stakeholder Enterprise. On today's show, did short sellers contribute to the collapse of First Republic Bank? And which bank is next on the list for short sellers to target? But before we get into that, I first want to tell a story. Now, the first time short selling stock happened is a story that goes back several centuries to the early days of the stock market. Legend has it that the first short sale of a stock was executed by a Dutch merchant named Isaac Lemaire in the early 17th century. Lemaire was a wealthy businessman who had invested heavily in the Dutch East India Company, also known as VOC. It was one of the most successful and profitable companies of its time. However, Lemaire became increasingly frustrated with the company's management and its policies, and he decided to take action. So Lemaire came up with a bold plan to sell shares of the VOC that he did not even own yet. He borrowed shares from other investors, sold them on the open market, and hoped to buy them back later at a lower price. This strategy is known as short selling, and it was a revolutionary concept at the time. Lemaire's plan worked, and he made a substantial profit by buying back the shares at a lower price and returning them to their original owners. The VOC's management was outraged by Lemaire's tactics and they sued him for malicious and illegal trading. However, Lemaire defended himself by arguing that he had not broken any laws and that he had simply exercised his right to buy and sell shares as he saw fit. Despite the controversy, Lemaire's short sale was a landmark moment in the history of finance. It paved the way for development of modern financial markets and the growth of the global economy. Today, short selling is a common strategy used by investors all over the world, and it continues to play a crucial role in the functioning of the stock market. It plays this crucial role by weeding out which companies are committing uh, shortcuts, which companies are engaging in unethical behavior, and which companies are are not playing by the rules and treating their customers poorly. So short selling does play a very important role in making sure that the stock market is healthy, but there is a downside to short selling. Short selling can contribute from to a just a regular company's collapse by specifically targeting it, and then releasing rumors that this company's struggling. So more people start to sell, and a panic happens, and it can cause devastating consequences. So the story of the first time short selling stock was seen as the primary reason for a company's failure takes us back to the early days of the American stock market. In the early 1800s, there was a company called the United States Bank, which was one of the most powerful financial institutions of its time. Now, the bank had a lot of enemies, though, including President Andrew Jackson, who believed that the bank was corrupt and needed to be shut down. Around the same time, a group of investors began short selling the bank's stock in large quantities. They believed that the bank was overvalued and its stock price would eventually collapse. So they borrowed shares of the bank's stocks, sold them on the open market, and hoped to buy them back later at a lower price. The short sellers were right, and the bank's stock price did indeed start to drop. But as the stock price fell, more and more people began to panic and sell their shares, creating a vicious cycle of selling that drove the price down even further. As the bank's stock price continued to plummet, the bank itself began to suffer. Customers began withdrawing their deposits, and the bank was forced to sell off its assets to try and raise cash. But it wasn't enough. and eventually the bank failed, leading to a financial panic that lasted that caused a recession and lasted for years. This panic was called the Panic of 1837, and it was one of the most severe economic downturns in American history. And it led to widespread unemployment, business failures, and a general feeling of economic insecurity throughout the country. It was a turning point in American economic history and contributed to the ongoing debate about the role of government in regulating financial markets. Now, this story about United States Bank is eerily similar to what happened to First Republic Bank. First Republic Bank, um, they short sellers were betting that the bank's stock price would fall, and they were motivated. It appears to be that these short sellers smelled blood in the water like sharks. Seeing the collapse of Silicon Valley Bank, Signature Bank, and Credit Suisse in Europe. That the failure of that bank, or the troubles, it didn't quite fail, but the troubles that it faced were uh, short sellers were targeting it specifically. And I did a podcast on April 12th with the title "How the Next Bank Will Collapse." And I said short sellers are going to target the next bank, and it's going to collapse. And that's exactly what happened. Short sellers went straight from Credit Suisse and targeted First Republic. They already saw that there was a panic happening at First Republic, and um, it was bailed out by these big banks. The big banks tried to bail out First Republic to kind of ease the bank customers from doing a bank run on it, and it did for a little bit. But when people found out how much uh, money was withdrawn from First Republic, it just created another panic, which there was no turning back from. The short sellers made a killing, absolute killing. The stock price fell by 95% from the beginning of the year. It was well over $100, $120, something around that, the stock price in the beginning of the year. And the day of its collapse, it went down to $4. So short sellers absolutely made a killing. Um, so guess what? Short sellers are targeting another bank right now, more so than any other bank, and it's called Fifth Third Bank Corp. Now, Fifth Third Bank Corp is a regional bank based in Cincinnati, Ohio, and it has a market capitalization of $18.7 billion, and it's the 15th largest bank in the United States. So it appears that the bank has a high valuation, and its stock price is trading at a price to earnings ratio of 15.4, which is higher than the average. They also have a high level of exposure to commercial real estate loans, which First Republic did as well. And the bank has 14.8 billion in commercial real estate loans, which is 12 over 12% of their total assets. Um, Also, Fifth Third Bancorp has been fined recently for violating. In 2019, the bank was fined $92 million for failing to properly monitor its anti money laundering programs. And this is just some of the problems that Fifth Third Bancorp has. I mean, that's a mouthful. Fifth Third. I'm having trouble saying that for whatever reason, but yeah, this bank in the Midwest, it's one of the largest banks in the Midwest. And if I had to predict which bank would fail next, if there is going to be another failure, it's going to be Fifth Third because of this targeting by the short sellers. So we have this issue of short selling, and it can cause good, but it also can lead to a financial crisis that lasts for years. And who knows what we're in right now? It almost feels like it's another financial crisis, and it doesn't seem like any of these problems will go away. And what's causing it? What is the cause? What's the root cause of these bank failures for hundreds of years? What's going on here? Now, in 1837, that's really when it really amped up the debate of government regulations of the financial markets. And many people, politicians especially, believe that the root cause for banking failure is government response, either too much regulation or not enough. The people who argue that it's too much regulation is that regulations are expensive, and it increases the cost for the bank to operate, and which makes it creates a increasing pressure to still be profitable, because that pressure is not going away. So you have these regulations making the bank's expenses uh, go up. Now the people who are saying, hey, there's not enough banking regulations, are saying that, yeah, there's not enough banking regulations because they're still abusing the public. The banking industry is the most abusive industry in the United States to its customers. uh, the top four banks in the United States: number one, Chase; two, Bank of America; three, Wells Fargo; four, Citigroup. They control half of all the banking assets in the United States. And they are at the very top of the list of companies that have been the most fined since 2020. You can look this up for yourself. It's the Violation Tracker Project. They track all corporations operating in the United States, and they track how often they get fined. So the big four, the most fined company since 2020 is Bank of America. The number two is Chase. Number five is Wells Fargo, and number six is Citigroup. And the reasons for their fines are things like toxic security abuse, investor abuse, and just run of the mill banking violations that they cause. Uh, Hidden fees and things like that. So we have the system and this cycle of banks under this constant pressure of increasing their quarterly profits, and in order to do so, they commit unethical acts, and which cause them to get regulated, which increases their pressure to increase their quarterly profits. That pressure never goes away, and guess what? It's a different unethical behavior that happens because you can't regulate everything. Regulations are very reactive, so it's this cat and mouse game where it's the cycle of regulations, uh, cutting corners, to loopholes, and getting regulated again. Costs go up, and in the end, who suffers the most? It's just us average American citizens. We're it causes for recession and turmoil and economic uncertainty, and it's very difficult to operate that. So, is government response the root cause? Not by a long shot to me. Um, it's the way publicly traded corporations are designed in the first place, which all these banks, they're all publicly traded for-profit corporations. They're designed with this pressure to increase their quarterly profits. If they don't increase their quarterly profits, well, the people working there, the executives, they'll get fired by the shareholders. The shareholders can hold the executives responsible for not increasing their profits, as a breach of something called fiduciary duty. And that happens all the time. You don't even need to be a majority shareholder um, to call for a vote to remove executives. You can be a minority shareholder to call for a vote. And so there's this pressure that's always there, and it's the way that companies are designed. Well, this will lead into the financial tip of the day, which is there is a way to design companies that is the infrastructure already exists, and you and I and every single person in the general public can participate in designing these companies. And we have an ability to design them that don't just look out for the shareholder bottom line, but a bottom line to all stakeholders. Now, a stakeholder is anyone who has interest in the success of a business, so that can be the customers, employees, vendors, suppliers, investors and shareholders, the environment, the community that this company serves. All of them are stakeholders. And there is a movement of designing corporations differently. You may have heard of benefit corporations or certified B Corps. All of these companies are designed that have the interest of all stakeholders. Now, there is a place that all of us can go to participate and profit off of this design of corporations that care. It's called equity crowdfunding, which is incredibly democratic. Um, we can all have a choice and a say of which companies get funded. Now, in the past, this wasn't even legal up until 2015. And now, since then, it's been 8 years, and there's these platforms that have really developed in the last 8 years and have stabilized, which uh, you, me, anybody can go on to and participate in this equity crowdfunding. And investment minimums are very reasonable. $100, many of them. Some of them I've seen even as low as $50 minimum investment requirements. So you could be invested in 20 different startup companies with as little as $2,000. Now, most of those 20 are going to fail, but you only need a few to really make it big and to profit from it. That is the basis of these venture capital firms that have been dictating who gets funding and who doesn't. And oftentimes, a minority and women get overlooked for funding from these VC companies. Now, that doesn't have to happen anymore. We need to have a more diverse and independent group of people saying who should get funding and who shouldn't. Why should we have a diverse and independent group of people uh, dictating this, or not dictating? It's democratically. Before it was a dictation, now it's more of a democratic way. It's because of something called the wisdom of crowds. The wisdom of crowds has been shown to beat the experts time and time again. It's the whole jelly bean, counting the jelly beans in a jar experiment. I don't know if you're familiar with this. Well, you take a jar full of jelly beans, and it's at a county fair, and you have people kind of write in how many jelly beans that they think are going to be in there. And you also probably have some experts, some jelly bean experts that are guessing too. So you take the jelly bean experts and you put their votes aside on one, and then you take the hundreds and hundreds, maybe thousands of people at the state fair that are guessing how many jelly beans are in this jar. And if you aggregate all of the guesses, you'll see that the people, the crowd, will guess very, very close the exact amount of the jelly beans. If you average it out, you take the average, and it will beat experts. And this has been shown not just with jelly beans, but in the stock market. It's been shown, and other ways where you can are able to aggregate this. So we have the power, the wisdom of crowds using equity crowdfunding. Uh, And there's something also to say about this. When we're engaging in equity crowdfunding or any type of investing, it's important to note what we're not investing in: the stock market and corporate bottom line. We're not investing in outsourcing, not investing in US companies manufacturing in China or other authoritarian controlled countries, all of which contribute to income inequality. My name is Paul Lovejoy. I am a crowd investor, and I see you are one too. If you'd like to know how to increase your own profits and benefit from preventing the collapse of our financial system, go to stakeholderenterprise.com.